Welcome to another Pendal podcast. Today I'm joined by Steve Campbell, Pendal Head of Cash Strategies. Steve, in Australia, inflation's above the target. We know that. Policy settings remain tight. In fact, the Reserve Bank has conceded that recently. How should investors think about the role of cash and short duration assets generally within a diversified portfolio?
Yeah, look, when we look at the role of cash, there are a few key factors that we need to consider. So, firstly, liquidity. They're cash funds. So, liquidity first and foremost is the key thing that we look at. But also capital preservation. Cash isn't the rock star of the asset classes. It is always going to be the boring asset class that people look at. But more and more, particularly now that we've had the Reserve Bank tighten monetary policy, taking the cash rate from 3.6% to our current setting at 4.35, it is giving our investors more and more income. So whilst it is defensive and it does have that, highly liquid sort of bent about it, it's actually giving our investors now more income than, where we were at 12 months ago with it. So all in all, the cash rate has increased by 75 basis points by the Reserve Bank. But when we have a look at what's changed over the last 12 months, October last year, we actually had 6-month rates at a low of around 3.63%. Now, that's actually closer to 4.8% at the end of June 2026. So 75 basis points, it's actually feeding through more to our end investors. So at 4.8%, when I look at that type of return, when you're in a highly liquid instrument, but there's also that capital preservation, cash at the moment offers a really appealing investment class for all investors, I think, at the moment.
Okay, and then that's very much that idea of balancing return potential on one hand and capital preservation on the other. Reading between the lines on what you're saying, it's actually a great period for cash in that sense.
Absolutely. Capital preservation for us is, I've touched on liquidity previously, but capital preservation is also the other key thing with any cash investment that we make. So all of the assets that we look at, in addition to being highly liquid, they're also short dated in their tenor. So we look at instruments like deposits with the banks, for example, that was referenced the RBA cash rate. So when you see a change in that RBA rate, it feeds straight through to our end investor. But we also look at other things like negotiable certificates of deposits or NCDs, and they mature within 6 months. So if you do start to see, credit environment deteriorating, for example, that this fund, it's not going to be adversely affected because the tenor of the assets is really short. So that ensures that our investors, their capital is preserved.
At the moment, we have interest rates rising, although they may be flat. We have inflation expectations shifting around. Depending on what market economists you're talking to, the next move is up or down. This incredible volatility in terms of the outlook, how important does that make liquidity in that environment?
Absolutely. Liquidity is the primary consideration for anything that we do. And particularly, as I said, we've touched on liquidity and capital preservation before. And one thing that I come up against quite a bit is just the role of, say, term deposits in a portfolio where people are starting to reach for a little bit more yield. But in my space, actually having access to more liquid securities, that introduces another avenue for us to actually add return to our portfolios. So we actively manage yield curve exposures. We actively manage credit exposures through that. So, typically we don't hold most of our NCDs to maturity. We'll sell them, 1 month prior to maturity, for example, or 3 months prior to maturity, for example. So that active management is certainly key, particularly depending on where you're at in the interest rate cycle. So I've mentioned before, 6-month rate at 4.8% from a major bank against a cash rate of 4.35. You actively manage that yield curve exposure and you're actually able to add more and more return. Now, the inflation environment can change. We had inflation that was down to 2.7% in mid-2025. And in that situation, the market was starting to look for the next move from the Reserve Bank to be a cut in monetary policy. Now, things have changed quite a bit since then. We had tailwinds in the economy over the second half of 2025. In turn, inflation's picked up. household consumption was picking up because you had tax cuts, you had basically real disposable household income picking up as commodity prices came off, and you also had dwelling investments start to pick up. So it's been a fast-moving environment. Even earlier this year, when we had tensions rising in the Middle East, inflation expectations picked up not only domestically but abroad. And at one point, the market was actually pricing in a cash rate that may have been closer to 5% at one point. So, it is a quickly moving environment. You need to be in liquid assets to basically try and make the most of those opportunities as and when they arise.
Steve, finally, what's the difference between the managed and stable cash plus funds against cash deposits broadly, potentially higher returning income funds? I know you've touched on that, but more specifically.
Yeah, look, I think this is where some investors can leave quite a bit on the table, in that our managed cash fund, it's predominantly an A1 plus rated bank. So, major banks, a couple of the overseas banks as well. And as at the end of June 2026, the yield on that fund annualised was at around 4.6% against a cash rate of 4.35. Now, you see a lot of bank accounts out there that are actually yielding well below 4.35. So, for me, that is an appealing pickup for investors, but I think it's where a lot of investors are leaving money on the table. We do have a diverse set of unit holders through the fund. So Stable Cash Plus gives a little bit more return than Managed Cash because it has exposure to some A2 rated names that we don't have in Managed Cash. So, they're the bigger banks. So we're looking at Bendigo Bank, Bank of Queensland, A2 rated names with a lot of issuance in the Australian market. We only invest in the larger issuers in the Australian market, and a lot of that is because of liquidity reasons. So there's been no lack of stress test in the system over the last 20 years. You look at GFCs, European sovereign crisis. You've had, obviously, the Trump administration a couple of times, COVID and the like with it. And with those larger banks, we just find that the support for their paper is a lot higher than what you'd probably get out of a smaller financial institution.
Steve, thanks for talking to us today.
No worries.
You've been listening to another podcast from Pendal. I'm Sean Aylmer.